Collapse of the Silicon Valley Bank. Hello everyone, I'm Rakshit Pai, and in today's video we'll understand what really happened with the American Silicon Valley Bank. Why did the bank lose almost 70% of its market cap in just 2 days? We'll see what actually happened, and does this have a snowball effect on the US economy and more importantly on the Indian economy. So let's get started. Silicon Valley Bank. SVB was once the 16th largest bank in the USA. When I say was once, I mean it was the case just 3 days ago. Look how dynamic today's market is. Look how even a small panic could literally kill a bank that had over 4 decades of experience with an ability to earn $3.2 billion in loan interest income as per financial year 2022. What happened to the bank? To understand what happened with SVB, we must first understand how the banking sector works. Basically, for a bank to succeed, all it needs to do is accept deposit at a lower rate and lend the deposit at a higher rate. Sounds simple, right? The difference between the deposit and lending is your net interest income. For understanding the SVB case, we'll hear Sir Uday Kotak's words, and I quote, "As long as there is cash and the economy is running, all is well. But as a bank, we'll have to test, experiment and try 100 different things. A few may work, a few may fail, but we have to experiment and try." This is where the SVB went wrong. SVB's loan book value is highly weighted on or towards startup lending. Apart from startup lendings, any excess amount the bank would invest in fixed income yielding US Treasury bonds. So what happened was that due to the constant rate hike by the US Fed, we have never seen such a drastic hike in the past 3 or 4 decades, by the way. So when the Fed raised interest rates from below 1% to now over 5% in just 6 months, when that happened, the already cash-strapped companies, that is the startups, felt the heat. They had no money to run their operations. So they asked the bank, the SVB, for their deposits back. Wherein the other hand, SVB, instead of holding into the deposits, SVB had invested them in bonds. Basically what happens is that when the bonds rate rises, the bonds value falls. There is an inverse relation between the bond price and the bond yield. So when the startups wanted to withdraw their deposits, and with SVB having invested these deposits in the bonds, the bank had no choice but to redeem the bond at current price. You understand what happened, right? With increasing interest rates, the bond value has reduced. So with interest rates rising and fall in bond price, the bank's bond portfolio has reduced in value. To fund the withdrawals from the startups, SVB sold a total of $21 billion worth of bonds and took a loss of this transaction worth $1.8 billion. For comparison, the bank's total net interest income for financial year 2022 was just $1.5 billion. To cover this loss of $1.8 billion and to keep the bank hydrated with cash, the bank went on to issue further equity and preference stock. This caused panic among the public. Adding insult to injury, the bank's top management, that is the CEO, CFO and CMO, sold $4.4 million worth of equities just a few weeks back. Before going further, if you wish to invest in an already set up portfolio that caters to your needs as per your risk profile, consider investing via ET Money Genius. We have 6 distinct portfolios for you to pick from. Check the link in the description for more information. Continuing the video. So what's next with the SVB? SVB is almost facing the same case as faced by the Yes Bank. Before anything further, the bank must first work on its goodwill in order to regain the confidence of depositors, investors and stakeholders in general. SVB's impact on the US economy. Although SVB is no doubt a large bank, the bank's impact on the entire economy is very minimal. Whether this incident can have a snowball effect, we'll have to wait and watch. In fact, the depositors, the startup community and the bond portfolio are the 3 participants in this transaction who face the heat. What's also noteworthy is how sensitive the US banking sector is. Even after the Lehman Brothers crisis in the late 2007, the US government has not learned its lesson, because a small bank run-in such as this could easily have a snowball effect on the entire US banking sector and thus the economy itself. This is probably why ace investors such as Mr. Bill Ackman are asking for US Fed to intervene before things escalate. SVB's impact on the Indian economy. I would say the impact of SVB on the Indian economy is close to nil. But what we can learn from this incident is that the bank must, number 1, diversify its loan books, number 2, invest in instruments other than treasury bonds, number 3, maintain a low NPA, number 4, immediate provisioning of bad loans, and number 5, audit of loan books from time to time. Lastly, and most importantly, the central bank must know when not to raise interest rates. At least not like this, wherein from below 1% to 5% in 6 months. Imagine such aggressive rate hike and its impact on the economy. For this I quote Sir Uday Kotak, where he says, market analysts and investors underestimate the importance of financial stability for balance sheet of a bank. When interest rates move up 500 basis points from zero in a year, an accident is waiting to happen somewhere. I hope that answers all your questions. If you find the video informative, consider like, share and subscribing. Thank you for watching.